The wealthiest clients I work with don't do tax strategies. At least not the kind that make viral content on Instagram. No hacks, no loopholes, and no schemes, and there's a reason for that. One, many people find out the hard way. Most business owners still think tax strategy is about finding clever tricks. The more creative, the more you save. And the internet, social media, conferences, they're all selling that idea. The truth is the opposite. The most sophisticated people I work with aren't chasing clever strategies. They're doing a handful of well-documented, well-structured things that hold up under scrutiny, and they're doing them precisely. The people who get burned are usually doing crazy strategies that they were convinced are not tax fraud when it is, or they might even be doing legit tax strategies, but they're doing them wrong. And the IRS has specific rules, some of them nearly 100 years old, for testing whether your plan is real or just paperwork. And if it's just paperwork, they can reclassify the whole thing and send you a bill that's bigger than the taxes you were trying to avoid. So today, I'm gonna walk you through the 5 most common rules that the IRS uses to test your tax plan. And any strategy that runs afoul of any of these rules should talk you out of doing that tax strategy. I'm Anthony Price, CPA. I run Priceless CPA. We manage over 200 clients, and I see every version of this. The one who gets it right, the ones who didn't. Here's what separates them. First, the substance over form doctrine. The IRS doesn't have to accept the legal form of your transaction. If what actually happened doesn't match what you put on paper, the IRS goes with what actually happened. This is the oldest and most foundational rule in tax law. Here's an example. Evelyn Gregory owned a company. That company held stock with about $133,000 in another company. Now, she wanted to own that stock in her personal name instead of her company's name, but if her company just handed it to her, she'd owe full income tax on that like it's a paycheck. So she created the brand new corporation, transferred the stock she wanted into it, then immediately dissolved this new corporation and took the stock on paper. That's called a corporate reorganization, and it is tax-free. But the corporation existed for 6 days. She had no employees, no business, no operations. It was created on a Monday, then dissolved by Saturday. This went to the Supreme Court, and the Supreme Court said, you checked every box, you followed every technical rule, but the question is whether what you actually did, setting aside the tax angle, was the thing the law was designed for. And a real reorganization involves real business activity. This was not a real reorganization. This was just a set of otherwise irrelevant procedures for her to save taxes. This is very relevant to today. If you have transactions on the books and you go, oh, can we just record it this way? A CPA should first think, well, what's the actual economic substance of your transactions? Like, is this a distribution or is this a loan? Are you receiving income or are you receiving non-taxable transfers into your account? Like, what's the actual economic substance? Is this a legitimate related party transaction or are you just making things up? So the short form from this Gregory test is, if I remove the tax benefit entirely, would I still have created this entity or done this transaction? The answer is no, it's probably vulnerable. Next is the economic substance doctrine. In 2010, Congress codified this into law, section 7701, 2-part test, you have to pass both. 1, the transaction must change your economic position in a meaningful way apart from the tax incentive. 2, you must have a substantial business purpose apart from the tax incentive. Fail either one, the whole strategy gets thrown out. And the penalties are different from anything else in the code. 20% of the underpayment, 40% if you don't disclose, no reasonable cause exception. This is strict liability. You can't just make up financial transactions that don't have real life substance. A nice story about this is David Watson, who was a CPA. He owned a practice at Nest Corp, part of a larger accounting firm that grossed close to $3 million. He paid himself a salary of $24K a year, but he took over $200,000 in distributions where he was saving his corporation and himself from paying payroll taxes. The IRS looked at this and said, you have a graduate degree, 20 years of experience, you work 35 to 45 hours a week at a profitable firm. Like, in what world are your services worth $24,000? So they brought in an expert, used actual compensation data, determined his services were worth at least $91,000. So over $134,000 in distributions got reclassified as wages, and he owed about $50,000 in back taxes, penalties, and interest. Now, the guy was just trying to save $10K a year in additional payroll taxes, and then he ended up losing $50K. The form here said that he had a $24,000 salary, but the substance, based on the qualifications, hours, the market reasonableness, said he should have been paid at least $91,000. Now, IRS and the tax court chose the real substance. So it's a good story for all you S-Corp owners who aren't paying yourself enough salary. And it's a good story for all you thinking about doing a tax strategy where there's nothing to it other than the actual tax savings. Like, if there's no real economic activity happening within the strategy, it is vulnerable. Next is the step transaction doctrine. If you break one plan into multiple steps to make each step look like an independent event, the IRS can glue all the steps back together into a single transaction and tax the combined result. Like, were these steps really one coordinated plan? If yes, then they're one transaction. So here's the story. Say you own a rental property worth $500K, $200K in equity. You want to access that equity without paying capital gains. Here's the plan. First, cash out, refinance. Pull $150K. Refinance proceeds, not taxable. It's a loan. Second, 3 weeks later, sell the property, do a 1031 exchange into a new investment property, deferring those gains. Each move is actually perfectly legal on its own, but the IRS sees the timing. You pulled equity out tax-free, then deferred the rest through the exchange. In tax court, the IRS actually collapsed the two steps into one transaction, and they treated that $150K cash out as taxable. Now you owe capital gains on this loan that you already spent. But there's a version of this where the taxpayer actually wins the court case. Frederick v. Commissioner. The refinance had been in the works for 2 years. There's an independent business purpose. There's documented reasons that had nothing to do with the exchange. That is okay, that wins. But in that other ruling, taxpayer who refinanced right before the planned exchange with no other reason, he lost. Here's a very real and relevant example. How about you buy a real estate property, you turn it into a short-term rental because of the tax benefits, but then the next year you turn it into a long-term rental, right? You may have gotten an active loss the first year when it was a short-term, but then the second year you get the ease of management and the consistent cash flow of the long-term rental without the pressures of the short-term rental. It's kind of getting the best of both worlds. Now, if you have this intention of converting it from short-term to long-term just to save taxes in the first year of ownership of the rental, then you're going to have that overturned. Like, that's illegitimate if they can prove that. But if some circumstances arise that changes your investment thesis or investment requirements, you can actually turn a short-term rental to a long-term rental and not be penalized for it. All about the intention. So the lesson here is to build time between your steps when you're doing complicated tax planning. Each step needs its own documented business purpose that stands alone. Why did you refinance? Needs an answer that isn't because I was about to sell. Don't create a paper trail that outlines the whole strategy as one coordinated plan. Emails and memos saying first X, then Y and Z are exactly what the IRS looks for. Now, the fourth rule is the assignment of income doctrine, where income is taxed to the person who earns it. You can't shift it to a different person, entity, or family member through contracts or paperwork, no matter how well drafted. This goes back to 1930 in the Supreme Court opinion of Justice Oliver Wendell Holmes. Holmes wrote, "The fruits cannot be attributed to a different tree from that on which they grew." You're the tree, your business is the tree, then comes the fruit. You can't take that fruit under a different tree and pretend it grew there. Examples would be, let's say a spouse that doesn't actually do any work. There's a court case where a spouse was paid $40K, she didn't actually do anything, therefore it wasn't deductible because it wasn't legit wages. Same with kids with fake jobs. If your 8-year-old earns $12K a year for no real work, it's not going to be upheld. Same with any other family entities. If you're putting all your income through a business and trying to arbitrage by putting it in the name of your parents, but they don't actually do any work, it's not going to be seen as legitimate even if you're paying the payroll or self-employment taxes. So here's what to do about it. For your spouse, find a real role with real duties. Document her hours. Pay a rate consistent with what you would pay a non-family member. Run it through your normal payroll system. Same for your kids. Their work must be real, age appropriate, and documented. And for income through entities, the contract should be with the entity, and the entity should direct and control the work legitimately. The test for all three, if the IRS walked in and asked, "Show me what this person actually does," could you show them? Last, let's talk about the penalty cascade that can come from strategies gone bad. Say a strategy saved you $100K. IRS audit 3 years later disallows it. First, savings disappear. You owe the original $100K back. Then the penalty of $40K because it didn't disclose. 3 years of interest too, $15 to $20K. Now you're sitting at $160K. Your $100,000 in savings just cost you $160K. You're 60 grand worse off than doing nothing. That real threat might make it not worth doing a tax strategy for you. On the extreme end, a story. CPA and an attorney sold over $1.3 billion in fraudulent conservation easement deduction. CPA got 25 years, attorney got 23. The IRS criminal conviction rate is over 97%. Nothing to play with. I've read articles of dentists that got involved in tax fraud trusts and got 6 years in jail. He wasn't even a tax pro, just a guy that went along with a lot of BS on tax returns. Now, every year the IRS publishes the Dirty Dozen, and the schemes are actively targeted. Conservation easements, micro-captive insurance companies, dumb social media tax hacks. That's literally on the Dirty Dozen posted by the IRS. And when a scheme gets enough attention, it becomes a listed transaction, like it's mandatory disclosure. You're not avoiding scrutiny on these transactions. If you do these types of strategies, you have to invite scrutiny on these transactions saying, hey, I can prove these are legit. So before you implement any strategy, ask, what happens if the IRS audits this 3 years from now? Can I explain every decision? Is every entity real? Is every number documented? Does every step have a purpose beyond the tax benefit? If any answer is, I'm not sure, have that conversation with your CPA before you file, not after you get a notice. Your CPA really should be thinking about this before you file on your behalf. So let's talk about what a defensible plan looks like. When you make real substantive transactions and decisions, you can structure yourself to save tons and tons of tax from the IRS. Even if the IRS doesn't like it, there's nothing they can do about it. An example, Summa Family Holdings case. A family combined two things Congress specifically created for tax savings. There's a special entity for exporters and Roth IRA. Over 7 years for the family, more than $5 million ended up in those Roth accounts, like way past the normal limits in the accumulation of these Roth IRAs. Like they followed all the rules, but they had massive Roth IRA accounts that the IRS tried to blow up for this family. The Sixth Circuit Court said no. Congress created both of these tools for tax reduction. The family used both for exactly these purposes, so you can't create tools for tax saving and then punish people for using them. Like, you can beat the IRS. You just have to be very well documented and smart about how you go about doing tax strategies. Most people selling tax strategies are not capable of beating the IRS, let's be honest. So let's go over the 5-question checklist again. Does it change your financial position beyond your tax bill? An S-Corp changes your structure, but a sham entity that does nothing changes nothing. Does it have a business purpose beyond tax savings? A retirement plan? That builds real well. A scheme that only exists to generate a deduction has no purpose without the tax benefit. 3, can every step stand on its own? A refinance done 18 months before a 1031 for cash flow reasons stands alone. 3 weeks before the 1031 with no other reason to do it, that does not stand up on its own. 4, does the paperwork match reality? Every entity real and operational, every employee doing real work, every payment supported by actual services. 5, is everything documented? You have market data for your salary, job descriptions for your employees, business purpose memos for entities. Documentation isn't just for audit defense, it's what separates planning from just hoping you don't get audited. So if your plan passes all 5, you're using the system the way it was designed. S-Corp elections, defined benefit plans, cost segs, QBI deductions, 1031 exchanges, depreciation, family employment, all kinds of strategies. Done right, every one of these changes your economic position. It has a purpose beyond taxes, it stands up independently, matches reality, and it's documented. So why don't rich people do tax strategies? All right, well, you got me. Like, they do tax strategies, but they just don't do what most people think of as tax strategies. They don't chase the cleverest strategies. They don't try to save $10,000 by gaming their salary and end up losing $50,000. They don't form entities that exist on paper and nowhere else. They don't stack 3 strategies in 3 weeks and nobody notices the timing. The sophisticated business owners aren't doing schemes. They may be doing similar strategies to what everyone else is. Again, S-Corps, retirement plans, real estate, family employment, business investments. But again, they're just doing them with substance, documentation, precision. If somebody offers them a tax strategy without these things, they say no. That's why they don't do these strategies. They realize these tax strategies could offer so much, but could also end up being so much more of a headache than they're willing to deal with. And that's the difference between a tax strategy that saves you money and a tax strategy that costs you everything. So if you want to run your plan for those 5 questions with someone who does this every day, check out the link in the description, book a call with me or my team. Thanks for watching.